Welcome back to the channel. Today, we're diving into the essential calculations every real estate investor should know. Whether you're a seasoned pro or just starting out, these numbers are crucial for making smart investment decisions. We're talking about the metrics that can make or break your success in the real estate game. So buckle up, grab your calculators, and let's get started. All right, let's kick things off with the most important number in real estate investing: cash flow. This is the money that's left in your pocket after all expenses are paid. We're talking about your mortgage payments, property taxes, insurance, maintenance, the whole 9 yards. Positive cash flow means you're making money each month, while negative cash flow means you're actually losing money. You want to aim for properties that generate strong, consistent cash flow. That's how you build long-term wealth in real estate. Now, calculating cash flow might seem intimidating, but it's actually pretty straightforward. You start with your gross rental income, which is the total rent you collect each month. Then, you subtract all of your operating expenses, like those we just talked about. The number you're left with is your net operating income, or NOI. Finally, you subtract your mortgage payment from your NOI to arrive at your cash flow. It's that simple. ENOI is essentially the heartbeat of your real estate investment. It tells you how much money your property generates before factoring in any debt obligations. Imagine you're running a business. NOI is like your revenue minus your operating expenses. A higher NOI generally means a more profitable and desirable property. To calculate NOI, you start with your gross rental income again. But this time, we're only subtracting operating expenses, not including your mortgage payment. This gives you a clear picture of the income your property produces from its operations alone. Keep in mind that accurately tracking your operating expenses is crucial for determining your true NOI. Cap rate is a fantastic tool for quickly comparing the potential profitability of different investment properties. Think of it as a measure of how much return you can expect on your investment based on the current income it generates. A higher cap rate generally suggests a higher potential return, but remember, it's just one piece of the puzzle. Calculating the cap rate is a breeze. You simply divide the property's net operating income, NOI, by its market value. So, if a property generates $10,000 in NOI and has a market value of $100,000, its cap rate would be 10%. Easy, right? Chapter 4. Cash-on-cash return focuses specifically on the return you're getting on the actual cash you invested. This is important because it takes into account how much money you borrowed versus how much of your own money you put down. A higher cash-on-cash return means you're getting a better return on the money you personally invested. To calculate your cash-on-cash return, you'll divide the property's annual pre-tax cash flow by the total cash you invested. This includes your down payment, closing costs, and any upfront renovations. For example, if your pre-tax cash flow is $5,000 and you invested $50,000, your cash-on-cash return would be 10%. Chapter 5. The GRM is a rough estimate of how long it will take for a property to pay for itself based on its rental income. It's a quick way to get a general idea of whether a property is overpriced or undervalued. Keep in mind, though, that GRM is just a starting point and shouldn't be the only factor in your decision-making. To calculate the GRM, you divide the property's market value by its gross annual rental income. The lower the GRM, the faster the property could potentially pay for itself. For example, if a property is selling for $200,000 and generates $20,000 in annual rent, its GRM would be 10. Chapter 6. The DSCR is crucial when you're looking to finance an investment property. Lenders use this ratio to assess your ability to repay your loan. A DSCR of 1 means you're barely scraping by, while a DSCR above 1 indicates you have a cushion to cover your debt obligations. Calculating the DSCR is simple. You divide the property's net operating income by its total debt service. Total debt service includes your principal, interest, taxes, and insurance. A higher DSCR generally means you'll have an easier time securing financing. The LTV ratio is another essential metric that lenders use to determine your risk level. It represents the percentage of the property's value that you're borrowing. A lower LTV means you're putting down a larger down payment, which typically translates to lower interest rates and more favorable loan terms. Calculating the LTV is straightforward. You divide the loan amount by the property's appraised value. For example, if you're borrowing $150,000 for a property valued at $200,000, your LTV would be 75%. The IRR might sound complex, but it's a powerful tool for evaluating the profitability of an investment over time. It considers the time value of money, meaning that money you have today is worth more than the same amount in the future due to its earning potential. Essentially, the IRR is the discount rate that makes the net present value, NPV, of all cash flows from an investment equal to zero. In simpler terms, it's the rate of return you can expect to earn on your investment over its entire lifespan, factoring in the time value of money. ROI is a fundamental metric used across various investments, not just real estate. It tells you how much profit you've made on an investment as a percentage of your initial investment. It's a simple but effective way to assess the efficiency of your investment. To calculate ROI, you subtract the initial investment cost from the final value of the investment, then divide that number by the initial investment cost. For instance, if you invested $100,000 in a property and sold it for $150,000, your ROI would be 50%. The break-even ratio is all about understanding the minimum occupancy rate you need to cover all of your expenses and avoid losing money. It's a crucial metric for assessing the risk associated with a rental property. A lower break-even ratio means you can withstand higher vacancy rates without dipping into the red. To calculate the break-even ratio, you add your operating expenses and debt service, then divide that sum by your potential gross income. This will give you the occupancy rate needed to break even. For example, if your expenses and debt service total $10,000 and your potential gross income is $20,000, your break-even ratio is 50%. The OER helps you understand how effectively you're managing your property's expenses. It measures the percentage of your gross operating income that's being eaten up by operating expenses. A lower OER generally indicates a more efficiently run property. Calculating the OER is simple. You divide the property's operating expenses by its gross operating income. A lower OER means more of your rental income is flowing to your bottom line. Price per square foot is a commonly used metric for comparing the value of different properties in the same area. It provides a standardized way to assess whether a property is priced competitively. However, keep in mind that it doesn't account for differences in amenities, location, or other factors that can impact value. To calculate the price per square foot, you simply divide the property's market value by its total square footage. This metric can be helpful when comparing similar properties in the same neighborhood. And there you have it, folks. These 12 calculations are the backbone of any successful real estate investment strategy. By understanding and utilizing these metrics, you'll be well equipped to make informed decisions, analyze potential investments, and ultimately build a profitable real estate portfolio. Remember, knowledge is power in the world of real estate investing. The more you understand these calculations, the better prepared you'll be to navigate the market, negotiate deals, and achieve your financial goals. So keep learning, keep crunching those numbers, and keep building that real estate empire. Contact me if you'd like to start or expand your investment portfolio.